What must you know before investing? In this month, we talk about markets at all-time highs. How do you look at markets at all-time highs? How do you invest in markets at all-time highs? Now, this is a chart that shows the Nifty from 1990 September and tells you where all it touches all-time highs. All the dark blue bars here in this chart tell you where the markets have hit an all-time high. What we do then is we break this data down. We look at all-time highs and we see if you as a lump sum investor had invested in an all-time high market 1 year later, 3 years later, and 5 years later, what do your forward returns look like? Now, we have summarized all this data that we crunched in 3 small tables. This pertains to large cap, this pertains to small cap, this pertains to large cap, this pertains to mid cap, and this pertains to small cap. Now, how do you read these numbers? Just look at the 12% row that we've highlighted here. What this data tells you is if you have invested at an all-time high market as a lump sum investor and you held on to your investment for at least a 5-year period, there is still only a 34% probability that you have made more than 12% CAGR. There is only a 39% probability in mid cap that you have made 12% CAGR, and there is only a 35% probability in small cap that you have made more than 12% CAGR. Now, what should you do? If you are a lump sum investor investing in the markets today, you have 2 choices. You should either move in to diversify your portfolio if your time frame is fairly short, is 5 years or less. If your time frame is 5 years or more, then you don't really have much to worry. You can have a larger equity portion. But if your time frame is 5 years or less, you must look to diversify your portfolio and try to improve your risk-return metric.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.